Well, good afternoon, everyone. My name is Art Alvarez with MortgageWorks. Welcome to this week's Mortgage Minute, where we have the answers and they're on the house. Wow, what a week, huh? Obviously, some people are happy about this week, some people not so happy. But I think the good thing is we got through it. The election is over. And of course, there'll be a lot of back and forth about what went right, what went wrong. And as I said, some folks are not so happy about the outcome and some are. But I think the good news is we got through the process. It was, as they say, peaceful transition of power, at least so far. and I think we'll all survive and move forward, and hopefully in a positive and a unified way. So, but it made for a really interesting week, obviously, as everyone was waiting with bated breath for this event and what the outcome was going to be. And of course, now we know. And of course, it has some impact on what we talk about every week on this show about the mortgage industry, the financial markets, the bond market. So we're going to talk a little bit about that today, in particular about, to what extent does an election like this, presidential elections, how do they affect the mortgage market? So we're going to get into that a little bit later in the show. But as you know, what we'd like to do to start off with is give you an update on mortgage rates. And of course, the other thing that happened today was the Fed meetings. They concluded today with their announcement on what they're doing with the Fed funds rate. There's our rate grid. And what you can see there is, of course, we are still at the basic levels we've been at now for the last week or two. We're basically in the six to mid sixes, depending on loan type. Conforming 30-year fix is about 6.5 right now for a good credit score, decent down payment. FHA VA is, earlier this week was like literally a little over 6%. Now we're kind of right there at just under 6 at 5 7/8 or 5.99. And of course, jumbo's in the mid sixes. So again, this is a big increase from where we were 6 weeks ago, right before the last Fed meeting, when these rates were generally almost a 1% lower than what they are now. But again, not the end of the world. We certainly aren't back to the sevens or the eights as we were about a year ago. So all in all, pretty decent level that we're at. So let's go ahead and talk a little bit about what's behind where these rates are at. And we're going to show you, first of all, there's the bond chart. That kind of tells an interesting story. We actually saw some dip in bond yields Tuesday and Wednesday, or at least early Wednesday. And of course, that's not unusual. That we often see that right before the Fed meetings start. And by the way, this week the Fed meetings were pushed back a day because of the election on Tuesday. Normally, when the Fed meets, it's Tuesday and Wednesday, a 2-day meeting. This week it was pushed to Wednesday, Thursday. And what's really interesting when you look at this bond yield is the spike that occurred after the election results were made clear going into opening yesterday morning. The bond yield jumped up quite a bit. I mean, it got up to 445. It was getting awfully close to 4.5 as a result of it, of course, being announced that Donald Trump was our president-elect. And that's interesting. And we'll get into a little bit about what's behind that jump, because some folks might think, well, that shouldn't have been the case. Maybe it should have been the opposite. Maybe rates should have improved. But like I said, we'll get into that. In terms of the week, in terms of financial markets and the financial calendar, economic calendar, it was actually a relatively light week, obviously, because of the election. There was U.S. factory orders that came out earlier this week. And as we keep talking about, on the factory side of the economy, it continues to be soft. That factory orders tumbled 0.5%, fourth drop in 5 months. Now, on the other hand, ISM Services, that's the Institute of Supply Management Services Index, showed the fastest growth in 2 years. So we've got, again, this dichotomy between the factory side of the economy, not so good. The services sector is roaring. And of course, that's retail, that's restaurants. So it's interesting with all the moaning and groaning about how groceries cost too much, restaurants cost too much, food costs too much. People are paying those prices, and those sectors of the economy continue to be growing very strongly. So a little bit of a Jekyll and Hyde kind of personality there when it comes to the service part of the economy. And again, what happened yesterday morning is the bond yield spiked. It literally went up about 0.15. That's over 1/8% in yield when the bond market opened yesterday. And what was behind that? Well, the narrative was a couple of things. Well, with Trump winning the election, we're going to have universal tariffs. And of course, that's going to be raising the cost of products and services to consumers even more, which of course is inflationary. And of course, inflationary situations are going to be bad for the bond market. So that was part of the narrative. I'm going to dismiss that a little bit. I don't think that despite all of the election speeches from Trump about using tariffs, I think that's more of a negotiating tool that he's talking about. In fact, I saw Kevin O'Leary, as you may know, they call him Mr. Wonderful, very well known in the financial markets and on that program Shark Tank. I heard him interviewed recently where he argued that look, that kind of talk really is a negotiating ploy to threaten tariffs with other countries, in particular China, and in order for them to back off and play more fair in terms of trade. I tend to believe that more than the fact that we're going to suddenly be hit with all kinds of tariffs because of who's won the election. And so I think as a result, that was a bit of a spike that I think is going to settle down. And in fact, we've already seen that, as we showed you on the bond chart earlier. The other notion is a widening deficit may be happening. Again, the new President-elect Trump did a lot of speeches talking about all kinds of tax cuts, cutting taxes for on tips, cutting taxes on all Social Security benefits. And of course, these days, the economic world has sort of this kind of this fixed nature of if you lower taxes, then that's going to mean less revenue to the federal government. And so that's going to widen deficits. I talk about how I have a piece of paper from where I went to college that suggests I know something about economics. I do have a bachelor's degree in that. Of course, it's from 40 years ago. Where I went to school, we were still in sort of the supply side economic type of a mentality, where if you cut taxes, that can promote growth in the economy, and that ultimately cutting taxes can grow tax revenue, not reduce them. But these days, the economic world seems to have a more static approach, kind of more the Keynesian approach. I'm sort of from the supply side of things in terms of how I learned about the subject of economics. And so my belief is tax cuts in the long run should be good for the economy, causing growth. Remember, it was a Democrat, John Kennedy. He's the one who first suggested the idea of cutting taxes could actually grow the economy and grow revenue. So that's kind of an interesting sidelight there. But in any event, the way the financial market initially reacted, that was why I think that bond yield trickled up very quickly. And of course, remember, like we say, in the financial markets, they respond with reptilian-like minds to stimuli. And so I think yesterday was a very good example of how that stimuli caused that immediate reaction, but now it's settling down. And then, of course, the other big news today, the Fed concluded their meetings. They lowered the Fed funds rate another 0.25%. I don't think there was much impact on the bond market because it was already priced in. And I think you can see that when you look at where the bond yield is right now. And we've all learned now, I hope, as I keep harping about, do not focus on the Fed in terms of its effect on mortgage rates. It's not a direct correlation. And we now know very well, after the 0.5% reduction last month, mortgage rates have gotten worse by almost 1%, not better. And so don't expect this 0.25% drop in and of itself to cause much reaction on the mortgage rate side, at least not initially. Right now, the narrative has changed. It is more concern about deficits, more the need to sell more treasury bonds to fund those deficits. And when you put more bond supply into the market, that generally causes bond yields to go up. So with that, that's kind of where we're at with the financial markets, the bond market, and mortgage rates. And so now we're going to go ahead and talk a little bit about the election and what impact it's had on the mortgage market in particular. And there you go with our slide there. We call it, all of the delays have been removed. Let's go. The election is over. The Fed has spoken. It's time to buy a home. Of course, I've been saying for a while now, people should consider getting out there and buying a home now. Well, part of the, I think, excuse, if you will, for some people not to want to move forward with that is, oh, we want to wait and see how the election comes out. Well, it's over. We know the outcome. And so we've eliminated that excuse. So what we're going to do now is Jeff's going to come back on. We're going to talk about that a little bit in terms of how does the presidential election really affect mortgage rates? And given that we have this election now over, what should you do about it? Hi, Jeff.
Hey, Art. There's that old saying of buyer's remorse. And, as I was getting ready for the show today, I kept thinking, and I'm looking at the 10-year bond, and I'm thinking there are probably some buyers out there that have some remorse, not because they bought, is because they thought they should wait till election is over, until the Fed has spoken. And what's happened with that?
Well, I think if nothing else, people are learning their lesson, unfortunately, because you're right. I mean, it goes back to 6 weeks ago or 5 weeks ago. When the Fed met last month, they lowered the Fed funds rate 0.5%. And what happened after that? Rates got worse. They didn't get better. And as we've talked on this show before, I had many people I had been talking to, both on the purchase side and on the refinance side, who basically essentially said, no, I'm going to wait. First, it was wait for the Fed meeting last month. That happened. Outcome was not what they expected. And then it became or more of waiting because of the election. And this is something I've observed over many years, several decades, that every election year, particularly not so much the off election years, but the presidential election years, there's always a tendency to think that somehow that's going to have a significant or dramatic impact on mortgage rates one way or the other. And I got to tell you, I'm not sure that really bears out. And so I think that's also the case this year. Now, again, I just said, after it became known that Trump won, the bond yield spiked by quite a bit. Again, we almost got to 4.5. It's already settled back down. Most of what it spiked up to has already been recovered. So now we're back to more of what's going on going forward in terms of the financial markets. And of course, as I mentioned, the narrative has changed. It's now more about deficits. And what are we going to do about funding those deficits? And is tax policy going to affect those deficits and then maybe have an effect on mortgage rates? And so I think that's where the focus is now. And I'm going to argue that ultimately it may prove not to matter very much. In fact, I went back and looked at mortgage rates historically at different presidential years, and I really didn't see much correlation up or down, at least not significant enough to draw a conclusion that the elections matter one way or the other. Where I think the election matters, it has to do with a couple of two or three things. One is uncertainty. I think the other is, what are the policy implications of the election outcome? And I think there was a third one, consumer confidence. So uncertainty was definitely a big factor in terms of where the purchase market has been this year in the housing market. I talked to an account executive with one of the wholesale lenders that I do business with. This was a couple of days ago. And her and I talked about how, of course, things have sort of slowed down again because rates went back up. The supposed refi boom is already moderated quite a bit. But on the purchase side, she mentioned to me that the election was a factor because she was advised by one of her broker customers, somebody like us that deliver loans to her company, that they were going to have 2 loans that they had in their system registered and in process. They were canceling. They were canceling their purchase. And I asked her, well, why was that? She said the reason the broker gave to them was these buyers were canceling because of the election, because they had too much anxiety about what the election could mean as it relates to their, being in escrow to complete this purchase. And so their anxiety was at such a high level, they decided they couldn't take it and they canceled.
Wow.
And now I didn't ask why, like, well, is it because they were, hoping for Trump or hoping for Harris, or I didn't get into all that. I mean, it doesn't really matter, but that kind of give you a good example of how people's, the uncertainty of a, major event like this can really get people off focus and get them all balled up to the point where they can't move forward. And they actually, I mean, again, believe it or not, they canceled their purchase even before they knew the outcome. I mean, what does that say? Pretty interesting.
Well, I think it's interesting and how, I took about a 45-day, maybe almost a 60-day hiatus from the news because I felt like it was just a lot of propaganda from 60 days on in. He said, she said. And I kind of made my decision. And I didn't, for the first time, I didn't really feel that anxious about the election. I was anxious about who was going to win, but it wasn't stopping me from doing anything that I hadn't already planned on. And I think you made a good point. Is historically, it has made no difference if you're thinking about buying a home. It has made no difference historically on mortgage rates.
Well, exactly right. Plus the fact that the election as an event, uh, regardless of the outcome that you wanted and that doesn't in fact happen, even to the extent it's going to affect something like a mortgage rate, it's not an instantaneous phenomenon. It takes time. I mean, we now are going to have, a new president, somebody who's back again after being gone for 4 years. What's going to happen with mortgage rates is going to have more to do with, like I said earlier, the policy implications of the change in the administration. What is the new incoming administration going to do with fiscal policy, with tax policy, with tariffs? And to what extent will that have an impact on the financial markets, in particular the bond market? Because again, I keep saying the bond market is what you want to watch to see where mortgage rates are going. So those policy implications will play out, but it's going to take time. It's not going to be like, okay, we have a winner, and now and within a month, rates are going to go from here to here because of who the winner was. It's not that. It doesn't work that way. It's got to play out. Of course, policy takes a long time to, consider and get it passed and get it implemented. So this is going to be a longer haul phenomenon, and it's going to take a lot longer to see where rates go because of this event.
Well, so what do you think, if now again, not a crystal ball, but just data, what should prospective buyers, what should they do now?
Well, I think, and I'm going to say, by the way, in a minute here, not just buyers, but homeowners as well, if you're contemplating a refi or trying to get cash out of your home. But if you're a home buyer right now, if nothing else, I would hope that you have come to the realization that, as we have said on this program in past episodes, in terms of higher mortgage rates, they're going to be higher for longer. There is not this dramatic drop in interest rates around the corner to where we're going to go suddenly from low to mid sixes to low to mid fives, or gosh, it'd be great if we got into the fours. That's not around the corner. In fact, some of the major market players like Fannie Mae have sort of reassessed their interest rate forecast for the coming year, and it's not in particular anything real aggressive. We're probably going to be sticking around this 6% plus or minus level for an extended period of time. So if you're a prospective home buyer, I think what you've got to do is, number one, embrace the fact that we're going to probably be at these levels for a while. One of the things the Fed did announce today at the conclusion of their meeting is noticing that inflation continues to be rather stubborn. Well, that kind of language, when you kind of peel the onion and interpret what that means, is what they're kind of signaling is, to the extent we're going to have more reductions in the Fed funds rate, it's going to be slower and it's going to be more modest. So we should not expect that suddenly in 2025 we're going to go from the current level of the Fed funds rate at 4.5 to 4.75, and suddenly it's going to be dropped to 3. That's probably not going to be the case. So if you're a if you're a home buyer or prospective home buyer, I think now is the time to realize we are where we are, and we should, if we need or want to buy a home, we should really consider going ahead and pursuing that. First of all, find out, with somebody like us, we can help you determine if you can qualify at today's mortgage rates. And then understand that if we can determine that, we can provide you the financial tools to go out there, find the home, and make an offer and improve the financial impact of getting that mortgage. And of course, what I like to talk about in that regard are temporary interest rate buydowns. I call them buydowns are the bomb for a reason. They are a way for you to take advantage of the current housing market environment. Rates are where they are. They're going to probably be at these levels for a while. There is more inventory on the market. We are seeing a little bit more movement in list price to actual closing price, where closing prices are now starting to more commonly be at 97, 98, 96% of the original list price. So it's shifting slowly, both in terms of inventory, but also buyers having more leverage. And so with this environment, we can show you how using a temporary buy down is a great way to take advantage of a home ownership. Because again, as I mentioned at last week's program, and frankly, I have been for several weeks now, several months now, home prices do continue to go up. Now they're moderating. The rate of increase in home prices is moderating, but they're still going up. They're not just dropping. So given that's the case, the temporary buy down scenario is a great program to use to take advantage while you can now get into home ownership and then be able to benefit from that appreciation after you're able to close on that purchase.
Well, that brings up a really good question, because we didn't talk about it when you were talking about your rate grid. I noticed that from last week to this week, your temporary rate buy down on a 3.21 actually went down a little bit to around 3.5 from 3.65, if I'm not mistaken. Is that correct?
That's correct. In fact, it's just last couple of days. We try to keep that rate grid updated on a daily basis. And what was interesting from Tuesday to today, Monday, Tuesday, we were at like 3.625 as the first year rate on a temporary buy down. That means the note rate was at 6.625, 6 5/8. Yesterday, we had to update the grid. Why? Because of that spike in the 10-year bond yield also meant a spike in mortgage rates. So yesterday, we had to take that 3.21 buy down from 3.65 to 3.75.
Oh boy.
But then today, with that pretty nice drop from that 4.45 10-year bond yield to now about 3.32 or 4.32, that's about almost an eighth in rate. So what's happened? The 30-year fixed, conforming loans back to 6.5. It's better, and the temporary buy down has dropped as well, to take into effect what's happened in today's bond market after that initial spike because Trump won. Again, that's what tends to happen a lot. You sometimes have to give it a day or two and let the market kind of digest their initial reptilian reaction to the data and think it through a little bit more and realize, okay, the world's not coming to an end. Let's get back to fundamentals. And then what typically happens is you start to see those yields settle down. And so I think that's what we saw the last couple of days.
Well, speaking of that, and then I'll let you go finish the rest of the show, but, looking forward, I know you said it takes a while for it to shake out, but how do presidential election years shape the housing market and mortgage rates going forward? Like, is it a 3 month, 6 month kind of period after kind of the world gets used to it? Because I know we saw the markets really explode yesterday with a $1,500 point surge. And, I saw that and I'm like, do I even look at the 10-year? Because usually it goes up too, and it did. So how long will it take in your history and your experience before it starts settling down and really, so if I do take advantage of using a temporary buy down, is it 3 months, 6 months, a year before I can say, hey, I can move now into a fixed rate possibly?
Yeah, I think so. It's going to take many months because, again, and yesterday was a very good example. It's kind of mixed signals, right? Trump wins, stock market explodes, up 1,500 points, but yet the bond market thinks that was bad news that Trump won. The bond yields jump up. Well, what were those signals? Well, the 1,500 on the stock market side was great. Here's a pro-growth president coming into office again, and we know from past experience the economy was pretty good back then. Prices were low. So here we go for round two. So the stock market thought it was great news. We're going to have now a better growing economy. Inflation's going to get more under control because of who's coming in, because we have past experience from 4 years ago where we saw that. The bond market, on the other hand, is going, wait a minute. Yeah, maybe a growth economy when he comes back in, but there could be more deficits because of his tax policy. And so as a consequence, that means we're going to have to sell more treasury bonds to finance that deficit spending or that deficit outcome from low tax revenue. And so therefore that could be bad news. So the point of it is that with this presidential election, it's going to take several months because first of all, we're still waiting to see, are the Republicans going to control the House of Representatives? Looks like they got the Senate. If they get the House of Representatives too, it's a sweep. So that would suggest that the new president is going to have pretty much carte blanche to get a lot of things done that he's said in a lot of speeches, which based on what he's saying could be very good news. A high growth economy, get inflation more under control, improve real wages. That all could be very good for the economy, and that could over time bring rates down, so that, yeah, if you get into a market, into the housing market now to buy, use that 3-2-1. So you're getting a rate in the threes the first year, fours the second year, fives in the third year. That gives you that great longer term window to see these policy proposals and implications play out, because it's got to go, a lot of it's got to go through Congress. You can't just wave a wand and make all these changes. There's a process, a political process, and so that's why you have to give it some time. It's probably going to be at least probably 6 months to a year to really see how it impacts mortgage rates. And based on everything that was in all those speeches, it could very well be good news, but we're going to have to see it play out.
And it sounds like from all of this that you said, again, if I were a prospective buyer, I should take advantage of the market right now, because there's no indications that the prices homes are going to be coming down. They've continued to go up, but they're not going up as fast, but they're continuing to go up. But there are more homes on the market for a longer period of time, which means now if you use something like a temporary rate buy down, the chances of you getting a seller concession, because they're going to be discounting potentially anyway to sell their home, is really a good play. Is that correct?
I think so, because I think your opportunity to get some of those seller concessions is right now probably as good as it's been in the last couple of years. And again, if all of what our new president proposed in his speeches and campaigning proves to be true, if he's able to make some policy changes that are going to grow the economy, get inflation under control, lower prices, improve wages, real wages, net of inflation rate, that is going to generally be a case where the housing market is going to get stronger. We're not going to see a recession. The idea of a recession starts to get way out there, very, very unlikely. And so if the recession's off the table, a growing economy, a growing labor market, that's going to be good for the housing market. And what is that going to do to housing prices? It's going to get them going up even further. Remember our friend who used to talk about, from the Shark Tank, where she said, Barbara Corcoran, when the rates, when they do come down, guess what home prices are going to do? They're going to go up. And so if what he has been saying proves to be the case, he grows the economy and lowers rates, guess what, folks? You think home prices are too high now? It's only going to get worse. That's why using these temporary buy downs in this little window we have, where you have some leverage on negotiating your price, that's what you should focus on. So you get into the housing market now and then enjoy that appreciation when the economy improves, rates fall, and then you refinance your note rate for a longer term, lower rate scenario.
Sounds like a win-win. Art, thank you so much. I appreciate it. I'll give the show back to you. For more information to call Art, just call him at 760-969-5023. That's 760-969-5023. Ask him about the temporary rate buy downs and anything else. I do want to ask you, and you can do this after I leave, but I did notice, because of the quarter point drop, will we see those interest rates fall a little bit more on the HELOCs?
Yeah, very good point, actually, on Jeff. Yeah, if any of you as homeowners, if you have a HELOC, or if you're contemplating getting a HELOC, today's new news with the Fed reduction of 0.25%, that does directly correlate to HELOC rates. Most all HELOCs, home equity lines of credit, are tied to the prime rate, the commercial bank prime rate. So if you have a HELOC, today's Fed announcement is going to lower your HELOC rate another 0.25%. You should have already experienced a 0.5% reduction in your HELOC rate from last month's meeting. And if we do have another 0.25% in December, which is on the table as a possibility, your HELOC could go down another 0.25%. So that could mean between last month's meeting and today and next month, you could have potentially a full 1% reduction in your HELOC rate by the end of the year. So that's a good point that Jeff mentioned. So keep that in mind. And if you're contemplating a HELOC, that could be a reason why now is the time to go ahead and pursue that, because of the possibility once you get that HELOC, the rate on that loan is going to go down some more going into 2025. So with that, I want to go ahead and give you one example of a temporary interest rate buy down. Another example of why I say the temporary interest rate buy downs are the bomb, and I would say even more the bomb now given where we're at with the election and what should be unfolding over the next several months or year or two. So in this example, what I did is I looked at, first of all, the median home price here in my immediate market in the Coachella Valley. Of course, we make loans all over California, but I used as an example the median home price here in the Coachella Valley. The median home price is $640,000. So here's what I did. I looked up a listing. It's actually here in the valley, and the list price is $639,000. And in this case, what I want to use as an example is an FHA loan. I think FHA is a great product to use. You don't have to be a first-time home buyer. And if you're looking to buy a home with a minimal down payment, FHA is a great option. I would say the best option, because you're going to overall, whether you have a very good credit score or just an okay credit score, FHA is almost always going to be better on loan terms. So with our example here, $639 list price, 3.5% down payment. Your loan amount, including the upfront mortgage insurance premium, is going to be $627,000. Well, at a current 6% rate, and this was actually prepared yesterday, we're at 5 7/8 now. At a 6% rate for an FHA loan, your monthly principal and interest is going to be $3,762 a month. Now, this is for a single-family home with 3 bedrooms, 2 baths, and a little over 2,000 square feet. So, with that, that's kind of your baseline in terms of what's possible in buying that home. Well, here's scenario one, and I would call scenario one the most common approach that most home buyers and their buyer's agent tends to do. In this case, this listing I didn't put on the screen, but it's been on the market for 82 days. So it really needs a price reduction. 82 days on the market, not sold. That's a strong signal to the seller that they're asking too much. So a buyer and their agent who sees this, here's the most common scenario. Number one, they look at this and say, okay, we're going to offer 600. Well, at 600, the loan amount with 3.5% down payment and the upfront mortgage insurance, it's going to be 589. Well, at the same 6% FHA loan rate, their monthly principal and interest is going to be $35.31. Pretty good. It's about a $231 a month drop. So you can argue, sure, offering below list price by $39,000 is going to save you $231 a month versus going full price offer and going 3.5% down using a market 6% rate. Now, that's okay, but I think there's a better way. Scenario number two. Scenario number two, you still get the same amount of concession. But here's how you take that concession. You don't take it in the form of a lower price. You offer the full current list price. Instead, offer or request a seller credit of $39,000. That, by the way, is about 6% of the list price. With that $39,000, you'll use that to fund a 3-2-1 buy down as well as closing costs. And the reason I'm using an FHA loan in this example, FHA is unique, where when you're putting only 3.5% down, you can still get seller credits or seller concessions for your loan up to 6% of the purchase price. That's unique to FHA. Conventional loan with less than 5% down, you're limited to a 3% concession. FHA allows 6. So in this example, I'm showing you take that concession not in a lower price, offer full price. Take that concession, $39,000, as seller dollars taken from their proceeds, use it to fund your 3-2-1 buy down and closing costs. Your loan amount's still going to be $627 as per our initial assumptions at the top. With that scenario, your first year rate's going to be at 3. Your second year rate's going to be at 4. Your third year rate's going to be at 5. And with that 3.5% down payment, your monthly principal and interest the first year is $26.43. Go back and look at the top. Monthly principal and interest at a market rate at that full price offer, $37.62. What's the difference? $1,119 a month. How could you not do that? That is so much better than taking that lower price offer scenario where you're saving $231 a month versus full price. Instead, offer full price, get those $39,000 concessions as dollars from the seller, fund that 3-2-1 buy down. You'll save over $1,100 a month first year. Plus, you have a lot of money left over. The cost of that 3-2-1 buy down is going to still leave about $22,000. That's still going to leave a good amount of money on the table to use toward paying your closing costs. So as a consequence, you can fully fund that 3-2-1 buy down with that 39,000, and then use the rest to maybe buy down your note rate a little bit from 6 to maybe 5 7/8 or 5 3/4. Use the rest to cover all your closing costs. As a consequence, you can get that kind of payment savings the first year, get all your costs covered, so that the total amount you would need to complete the purchase is basically just your down payment of 22,000. So this is a great example of how I say temporary buy downs are the bomb. And so I'm on a mission to get more and more home buyers to understand this concept and get them and their agents to realize this is a much better approach. So if you're looking to buy a home and you're contemplating making an offer, in particular, if you're contemplating making an offer below list price, give me a call. At least let me know how much below list price you're going to go. Let me show you how you can use that same concession amount this way to vastly improve your payment history for the first 3 years, and then wait for that refi opportunity. And by the way, in terms of refi opportunity, I want you also to know, I mentioned a week or two ago in our program, we participate with a lender who's offering what they call refi 75, where they offer 0.75 points off the pricing of their loans for refinance transactions. We participate in that, plus our lender paid comp's only 1%. So with that, we can offer very, very aggressive rates on refinance loans. So keep that in mind. It's extended for another month through the end of November. So if you're a homeowner feeling like you missed that refi opportunity from last month's very low rates, call us. We can still give you some very aggressive rates on a refi. So I hope that helps you see how buying a home right now could be a very good option for you. So if you're on the fence about it, give us a call. Let us show you some numbers so that you can move forward and get that home ownership sooner than later. And with that, I'm going to go ahead and go to the closing question from last week. This is a good one. It's about temporary buy downs, actually. We recently obtained a mortgage where the seller paid 3-2-1 buy down for the purchase of a home. Will we be able to deduct the portion of the interest rate that the seller paid? Excellent question. I'm going to answer it, but by the way, I want to give you a disclaimer. I am not an accountant. I'm not a tax attorney. I'm not a tax preparer. So what I'm about to tell you, I want you to make sure you check with your tax advisor to confirm what I believe is the case when it comes to this question. Now, understand, number one, the IRS typically treats the prepaid interest, in this case, the buy down funds are considered prepaid interest. They consider that as a form of points. And so whether or not that's going to be deductible for you as the new homeowner, it depends on a few factors. Number one is it's typically going to have to be on a loan that's used to buy a primary residence rather than an investment property or a second home. Number two, in terms of the buyer payment qualification, even though the seller is paying the cost of the buy down, the IRS generally allows the buyer to treat the seller paid points as if they paid them directly. This means that you as the buyer can often deduct these points on your taxes. Then the third point to understand is generally points for a primary residence mortgage are deductible in the year that you pay them, assuming they meet all the criteria for immediate deduction. Loan secured by your primary residence, amount of the closing statement, and so forth. If the loan does not meet these criteria, the point may need to be spread out over the term of the loan. That's typically what happens on a refi. And then again, this typically is for purchase loans. When you're refinancing a loan, number one, you generally don't pay points too often. And even if you do, there's no seller involved. And so if you're paying points on a refi, you don't get to deduct the total cost of the points in the year that you pay them. Instead, you have to spread that over the term of the loan. So if it's a 30-year loan, the points you pay are spread over 30 years, or if it's a 15-year loan, spread over 20 years, and so forth. So I hope this helps. This is another example of why, when you're getting that 3-2-1 buy down, even though you're getting the money from the seller to pay for that interest subsidy for the first 3 years, you as the buyer should be able to deduct that interest on your taxes, so you're getting that tax benefit as well as that cash flow benefit from that much lower payment. Again, check with your tax advisor on this, but I believe you're going to find out that this is possible, and that should help you give you one more reason to understand why using a temporary buy down is a great strategy to buy a home now and not later. And with that, I'm going to go ahead and finish up with our closing question for next week. And this is actually a conversation I just had with a prospective buyer this morning. We've been told to avoid an FHA loan for a home purchase because of the high cost of upfront MIP. That's actually UFMIP is what that should say. Upfront MIP, that's upfront mortgage insurance premium. What is this for, and why does it cost so much? Excellent question. I'm going to show you why that's something to consider, why it is not so expensive that you should dismiss it as an option. So next week, I'll get into the detail on that, and I'll give you the answers on that, and they'll be on the house. So with that, I want to conclude with thanking you for watching and listening to this week's program. If you're finally settling down from the excitement of the election, I hope you can go into the weekend and enjoy a great weekend. And then we'll see you next week for next week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So long. Take care.